Nick, good to see you. So we've got relatively strong earnings, also low interest rates kind of driving markets. But you think that we're overdue for a correction. When's that going to happen?
Look, we've been wrong for the past couple of weeks, but certainly it's hard to argue that equities do look a bit toppy here. They're up about 8.5% since mid-March. It's quite remarkable in the fact that you shrug off any sort of bad news, whether it's economic data like the GDP numbers or the jobless claims that came out yesterday, or the concerns that are going on in Europe, Japan, and the Middle East. They seemed a lot more focused on corporate earnings, which is a good thing. But in the end of the day, I think that in order for the equity market to continue its rally, we're going to need to see some strong improvement in the jobs data and employment.
So when you talk about a correction, how much are you expecting to see? Or do you think that we're going to be looking at a bear market to come? Because, of course, as you say, you have some weakness perhaps coming in the U.S. economy down the road. Also, the fiscal rhetoric in the U.S. has gone right up. We're going to be looking at spending cuts as well as the end of QE2.
That's very true. We don't necessarily see a bear market. We see a short-term correction of maybe 5% or so, maybe not even that much. We're still quite constructive on the U.S. economy. Sure, they're going to encounter some soft patches, but there are some concerns that are out there, namely, like you said, the unwinding of QE2. Will the U.S. economy be able to stand on its own feet without the government assistance? And also, the rise in commodity prices, which is certainly impacting the U.S. consumer. They're being forced to slash a lot of their discretionary spending for stuff like the essentials, like food and fuel, and I guess to some extent Apple products. But really, we think that the U.S. economy will maintain its slow grind to recovery. We favor corporate bonds as opposed to equities because we think that the value is there, and there's quite a bit more value to be had over the next 12 months.
Which corporate bonds in particular, which sectors are you looking at?
We're very bullish on Asia. We've been writing about it for quite some time, and our fund has been investing quite extensively in the Asian region. Asia ex-Japan, I should say, has been one of the primary beneficiaries of quantitative easing too. The fact that money has moved out of the U.S. into other parts of the world, and you've seen that reflected in the currency gains. But Asia in particular is extremely attractive because of the fact that GDP is much higher in the region. It averages about 5% compared to the G3, which is about 2 or 3%. Earnings are much better for a lot of the corporations. There's a lot more international reserves that these countries have saved up for a rainy day, so they're less reliant on foreigners.
Right.
And also the fact that the volatility is much less. So the risk-reward characteristics are much more positive for the Asian region.
So you say investors need to reduce their risk to interest rates and interest rate differentials. Does that mean that we should be seeing investors move from developed markets to emerging markets or to places where they're come to the end of their rate tightening cycle?
Absolutely. If you look at Australia as a perfect example, they're sort of near the end of the rate hike cycle. CPI came out earlier the week that was a little bit higher than expected. So we do expect a couple more rate hikes in the near future. But the economy is running at full capacity. The economy is growing quite extensively. And investors can get quite high levels of risk. And if you're willing to take the currency risk, which at this point really doesn't seem like much of the risk because the U.S. dollar has been getting hammered so badly, then you can really reap some quite attractive gains.
Nick Maroutsos, portfolio manager at Kapstream Capital. We thank you very much.